Hey, good evening, guys. Ken at Tortoise Capital. This is the small group coaching cohort one, January 22nd, 2024. Yeah, I don't want to follow up on something Jonathan said. I'm going to borrow your chart here, George. Something that it literally just jumped into my head. So I'm if you take a look at the daily process map that I have one that says like when the market closes uh, here, I give gratitude for the trading that I did, and then forgiveness for the trading that I did, and then I'm looking to generate three sources of new symbols for the day ahead, and and those sources are any trade that is still open. So basically, any open swing trade. So as I was coming up towards the close, there would have been a decision to make about, do I terminate the day trade completely, or do I keep a swing trade partially open? Or was it a swing trade that's always been a swing trade and it just has never hit the stop, and so it should still stay open? So there's two sources of swing trades that get you to an open symbol. One was, it started off as a day trade and it was just so good that I felt like, hey, that was day one of a day trade that had a really huge move, and that's going to attract attention. And maybe there's more momentum tomorrow to continue the upward movement, or it's going to be a big move downward. So no matter what, it's really going to be in play tomorrow because it was in play today. And so I think about that as one source of an open trade was day trade that has become a swing trade. And the second source would be a swing trade that didn't hit its exit today. And so it's a swing trade and it's still a swing trade. So, that's going to be source number two. So there's going to be some number of symbols that are still open trades. And then when I review the charts, there's going to be new symbols that fire because of swing trades. And there's two sources of those. There's going to be patterns, or there's going to be a situation. And by situation, I mean a strategy or something that does not fit one particular mechanical rule set. Like, and then, so for the patterns, there's going to be six mechanical points. There's going to be 5DD, washout, channeling, overreaction, uh, triple screen, 551W, plus any continuation pattern. So if one of these patterns was open and it closed today with a winning trade, so there was a 5DD, so we frame it up and the thing works, and then boom, we hit our exit, and the exit bar looks something like this. And somewhere in there today we took our exit because we're supposed to. So we had a 5DD that made money, and the original stop was down here. A continuation pattern for me is any one of these mechanical signals that fired and had a successful trade. And then I just automatically say, well, that thing could, It could resume tomorrow, or it could continue to fail tomorrow, and it's going to give back all of this money that I earned from the original setup and then the winning trade. Check or hold. So for me, this this little continuation trade is like a 1 day opportunity. And what I'm looking for is a routine entry, a normal entry inside this. Now, I went on at length about this, I think, in the foundations course. So what I'd like to see is an orderly entry. And then I'm willing to take a mechanical entry to the long side, as long as it never violated. I'm sorry, that red line should have been drawn at the at yesterday's low. That's my risk box. Is just the mechanical entry. And my logic is that on the first one, on the first entry, whichever one of these swing trades was in play, it had to test out well for the 10-day high. You know, the 10-day high was up here as a standard swing trade target, and then whatever my mechanical risk was, it had to have at least 2-to-1, and I'm not drawn to scale, but there's one that's 5-to-1, and it gave me an entry. And so we took that entry, and then the exit was hit, and then that the day it closed, again, the bar looks like this. And it can be an open bar or closed bar, it doesn't matter. It was just that was the day of exit. So I just automatically set that up. And again, it had to be a winning trade. Now, I would like to see that it still has 2-to-1 to the 10-day high, but I actually don't require that, because what seems to be the most important thing to me, this is not tested other than to say that the continuation pattern as a strategy, rolling up all of those, is positive expectancy. Like that's a good idea to re-enter a successful trade that closed in the direction that it was successful. And so the fact that it was successful seems to be more important than getting a 2-to-1 to the 10-day high, especially if this thing went all the way, through the 10-day high or near the 10-day high and then rolled over. And now it's only a short distance to the 10-day high. Well, I'm never going to get a 2-to-1 on that, so I don't even take it. No, if it broke above a 10-day high on this move, then I'm going to be really happy. So I say that my standard trading practice has been, if I have a successful swing trade from one of these mechanical entries, and I get what I call a universal entry, for me, the orderly universal entry is that it opens inside the day before's body, and without making a new low, it doesn't violate the yesterday's low. It just opens in the yellow zone, in other words, and it goes through yesterday's high. I just automatically buy that using a full mechanical risk as 1R. And I started off and I think of that as day one technique. So this has really become an integral part of the mechanical swing trades. One of the things that we found was that this is not a bad, in a bull market, this is not a bad entry, even if there wasn't a previous successful trade. Like if it opens, so we tried this. This came out of one of our research weekends. A father and son uh, trading team came in and they said, we really like that continuation and we like the WMB3. So we just decided to do those two anyway. And what they found was the continuation pattern had a positive expectancy. So what that sort of says is that what I interpret is that the positive momentum of the first trade, you think of that as leg one, and if it opens in an orderly fashion and it just proceeds on through yesterday's high, that there is some short-term bonus of goodwill that it's just continuing the previous price. Now, the reason I came across that as a strategy was that for about 5 years, all I was doing was taking the formal structured trades. And I remember when this happened, it was like in 2001 when the internet bubble blew up. I think it was 2001, maybe it was 2003. But the market made a huge sell-off, and then it gave us a washout pattern. And we took the washout pattern and we cashed that trade. And then there were 7 kata twos. We weren't calling them kata twos at the time, but it was the channeling signal. At some point, it became the channeling signal. Like the channeling system requires that that you're, if that's the 200-day moving average, the channeling system requires that your price was above the 200 and then pulled back in an and until on Williams percent R that it was oversold, and it treats that as a buy on dip opportunity. And so whenever you saw that, no matter what in the channeling system, you just buy tomorrow's open. Wherever it opens, you buy the open and you use something like the rule was uh, yesterday's low, or you could use a 5% initial stop. So you had a buffer. And then about 70% of the time, this thing wins. And the exit was when the price got into I think it was like above minus 30. So it moved up into almost overbought, and then you exited because it was an anomaly that it was oversold, but it's a bull market, so you just buy on the dip, and then price moved back and recaptured, it rejoined the original trend, and then now the extra opportunity to own it was over, and then you exited. So that turned out to be year in and year out, anywhere from 70 to 85% successful in the big fat indexes. Well, we refined that a little bit. If you are trading like on hourly bars or whatever, you can qualify it with the 10-day high and all that. But just that simple rule turns out to be positive expectancy. So the point I would say is that this idea of the continuation pattern proved to be very interesting. And I discovered it after about 5 years of trading just the channeling and the overreaction and that whole through of very specific, these are all specific rules that have very strict criteria. Like 5DD, you have to have 5 lower closes. So there's a lower one, two, three, four, 5 lower closes. Now I can frame that trade and off we go with a mechanical risk. But if you had 4 days down and then 1 day up and then 4 more days down, you didn't get any signals. So there's a very strict mechanical interpretation of all 6 of those. Well, it turned out from the years like 2001, to the years 2015 when I was trading them mechanically, they were positive expectancy. It was a good strategy. But from about 2001 to 2005, what I noticed was that I captured the washout pattern, and then I just walked away from the symbol. And then when I looked at the S&P later, it turned out that there was what we came to call kata twos all the way up. And that if we had just noticed the exit, we had just noticed the routine exit somewhere on that day, and then just framed it as a mechanical entry with a mechanical stop at the low of the day, that if it opened inside the yellow zone, and just let it open, and then by the breakout above yesterday's high plus a nickel, and then just start off with that risk box of yesterday's range, and then just trail it, we were very happy. What we noticed, the other thing was that once you started using the moving regression lines, that whenever that thing got above the previous peak of the regression line, what we would now call an emerging dragon, that this thing was really kind of on its own. It could be trusted to do its own thing. So one of the things that we learned to do was to pay attention to it when it was in these early stages. And that is, if I can draw it that way, while it was still in the pocket. If I think of that as the pocket now, I'm wherever the RL10 turned, but it hasn't broken out of this previous peak yet. I wanted to pay attention in here, because if it was going to fail, that's probably where it would fail. But we learned with the continuation pattern that if you got an orderly entry and it broke through, you could re-enter and just call it a continuation pattern, regardless of what the original source of the swing trade was. So this ended up becoming a standard re-entry strategy that was very flexible on the earlier symbols. And the other thing that we learned was, as long as that made money on a paper trade, I could still take the continuation pattern. So a successful mechanical trade, whether I had taken it or not, said it was a good setup or a filter or an alert to trade it as a mechanical continuation pattern. So what I learned was to treat that as a situation, is that any successful mechanical swing trade plus a universal entry became something that was situational. It wasn't a pure mechanical system in that sense. I suppose with enough coding I could do it that way, but I never bothered to code it. I just noticed it and was ready to trade it as part of the rule. So the first category of symbols for tomorrow would be any any trade that was open. And then the second pattern was any new any new mechanical pattern, which was one of these six, and then any situation which started off being any continuation pattern. And for about 5 years or so, that was plenty. And that's when I started adding in what I would call the RLCO patterns, generation one and generation two. And generation two is where you get the SSC, Kata 2, collapsing dragon, owl, Z3 pinch, all of those gizmos. And the regression line fractal framework is now what I would call a situation. It's a situation because uh, simply the trade situation is sufficient. That there's a moment when I notice that I'm looking at my symbols that the RL 270 is way up here because there was a nice move, but there was a temporary sell off in the RL10, and it had come to a reversal. And then I noticed that if I just took something like one ATR, because I'm talking about swing trades here primarily, we'll see later on that there's other ways I can do it. If I just measure the number of ATRs between the belly of the RL10 and the peak or the current value of the RL 270. And if I call the RL 270 as the long-term buy and hold fair value, and I call the RL10 the trader's price, but that's the difference of opinion in what two different populations consider to be the correct price. Like the long-term buy and holders are willing to wait for time to pass, and they're sure that eventually this thing is going to come back to it. That whatever caused the strong move to get it up into here, there was just some kind of temporary anomaly caused the traders to take it down this far. And it's already started to reverse on the daily chart. That creates something like in this one, a 5-to-1 based on an ATR. That's a 5-to-1 ATR difference between the traders and the long-term buy and holders. And so if that's the case, that's a situation. That difference of opinion, that discrepancy in the estimate of fair value now says, well, if I could use one ATR as sort of like a daily risk, and if I had something like yesterday's bar was this, and I could get something like a mechanical entry here and something like a mechanical exit right here. Now suddenly I have a situation where on day one, if that thing actually opens in the yellow zone and then goes through yesterday's high, if that opens inside the yellow zone, and that's always the issue for me, is I just like to see an orderly open. I don't want to see opening outside of yesterday's range because then something else, some new variable has been introduced that I can't rely on yet. So I don't mind if there's a gap, and there's almost always a gap. I don't mind a gap. I just want it inside yesterday's range. And then if it goes above yesterday's high, I have evidence, I have new evidence that new buyers are coming in with a willingness to buy this at a higher price than they had yesterday. And maybe this is just the first day of what's going to end up being a correction of price moving back, the traders moving it back to something like the fair value. And that kind of a discrepancy between the RL 270 and the RL 10, especially if it's 5 ATRs, it might take 7 to 30 days for that anomaly to be erased. Like it could happen very, very fast. Like after an earnings announcement or bad news, this sell-off could happen fast. But the recovery might take a little more time as it climbs the wall of worry. And if I've got 5 ATRs to play with of potential gain, and I'm managing to a single ATR of risk, I might be making 2 or 3 trades in there with a mechanical entry and managing the stop, especially if I'm using the daily charts to frame this, but using the 30-minute chart to trade it. Now, this turns out to be a very relaxed way to handle what I think of as a situation. Now, if one of those situations happens where on the intraday move, I got a really enormous win and I got 5R on the win, well, maybe I'll sell 80% of it and keep 20%. And now that thing is in play. And now something that was a day trade and a turbo might end up becoming a swing trade because I decided to hold on. And so that's in one of those open trades. But if I sold all 100% of it, and then the next day it starts moving up again and makes a mechanical entry, I think of that as a situation that I'm ready for, and I think of it as a continuation. So the first two things that can be sources of that good intraday move, which might grow into a swing trade, is it's an open trade or it's a new mechanical swing trade. It's a new signal from a pattern, or it might be just a situation that fires from a strategy. So when I think of a signal from a system, I only think of those 6 mechanical signals because those are coded and there's a very mechanical entry. These other ones, which I think of as situations or strategies, is a place where I'm doing a little interpretation. And the first one of them was a continuation. And then what it became was as I learned these generation 1 and generation 2, when I look at the daily chart and I see it setting up as an SSC, then that became a situation. So SSCs, Kata 2s, owl patterns. Then it became the RLFF. So I started adding these things that are not coded per se, but which are mostly rules based, and they still have to frame out, but they are relaxed filters, if you will, or they're just scanning the sector, looking for targets, looking for animals in the wild that I'm just stalking, and I'm looking for favorable situations. And it turns out that those things from generation 2, the SSC, the Kata 2, the collapsing dragon, the emerging dragon, plus the Z3 pinch, all of those things on the daily chart become something that I could trade intraday if I just get a favorable move. And then the third category of entries was the usual suspects. And these turn out to be a little group of symbols that no matter what, I know are tradable intraday because they are frog champions. And that comes from understanding the statistics of the average range and the range stat, and they're also liquid, and they move in both directions, and they have reliably large moves. So I'm always on the hunt for those. And so that's like EWW, EWZ, DIA, Devon, Cliff, Alcoa, and lately IP, AI. Home Depot used to be in there. It's becoming less and less interesting. But anyway, these are ones that no matter what, I can look at them intraday and I can see the same situations intraday that made me interested in them from a daily chart. So when I'm doing my nightly prep, if I see a situation like an SSC on a daily chart, I'm interested in it tomorrow, and I can frame it out as a on a daily chart. I can see where's the price that I got to enter. But those same situations, I'm so used to trading that on the intraday with a 30-minute chart, if I see a harsh winter and it pinches and it crosses the dragon and hits the piece, and I see my little SSC on a 30-minute chart, I can take that trade in one of these old reliables just because I've taken it so many times that I'm just used to doing it. And I would say the typical entries for me, there's three of them. There's sort of the WMB3, there's the OR3, and there's the SSC. I might also, maybe I'd call it the 1, 2, 3 also. So there's probably four. And on when I see one of my old reliables and in one of those early entry situations, I can trade that just because of familiarity. So so now I've now identified that there's three categories of symbols that I'm interested in tomorrow. It's an open trade for whatever reason. I carried that overnight. I'm ready. If it was a new mechanical pattern, I'm ready to trade it. If it's a uh, swing trade situation from one of those, I'm ready to trade it. And then if it's one of the usual suspects, I'm ready to trade it. I'm now going to add a fourth slot because uh, it jumped into my head as we were talking um, with Jonathan, and it would and just as a way to think about it, what if I my fourth pattern would be those big gaps, the gappers, because according to my logic chain, if I want to if I have my usual suspects here and I've ranked it by the size of the opening gap, and I've told you that I like to find the ones that have extraordinarily large gaps or extraordinarily adverse gaps, that those are quite often the sources of either a big retracement or a continued fail, or a continued gain or a fade the gap. So that's actually the fourth category. So I was what pictured in my mind was what if I had four categories and two symbols in each one? I picked two that were open, two that were new patterns, two that were situations, and then two that were big gappers right away. So I could imagine how I have eight symbols, and then I just pick, and then my rule would be first come, first serve. And in that mindset, it's actually the ones that already started off with the big gap. They are already moving. They have the advantage of first come is because they're already gapped. Every one of these other ones, every one of these other ones ends up having some kind of trade box that I can know the day before that had something like a mechanical entry and a mechanical stop. So all of those can be done with prep the night before. The one, the ones that are the big gappers, whether it's this one or that one, I actually have to wait and see the situation unfold. And that situation, the pattern situation is going to be an OR3, a 123, a WMB3, an SSC typically, or a collapsing dragon. you know. So if this was yesterday's move and that's where it closed and it gapped way down here, and I see the first bar one, two, I'm in right there on a one because I have a 1, 2, 3, and I just draw that wrist box and bang, I'm in on a 1, 2, 3. If it's not a 1, 2, 3, the next one that usually fires is a WMB3 because it takes the big gap down causes the Williams percent R to be oversold. And then I get a MACD histogram uptick, and then I can play the breakout. So that usually happens, 4 or 5 bars into it. So the 1, 2, 3 could happen in the third one. Well, the OR3 could also happen if I'm on 3-minute bars. If I look at the 3-minute bar, like right here, and if this is bigger than an R10, I could actually, I feel like, hey, that thing has reversed. It hit this low and it's already reversed more than an R10. And I can set up my little R10 wrist box like this. And now it takes off. And I can put my stop in. So that's a case where the OR3 might be the first one to go. So those are typically the ones that are first out the door. The SSC and the collapsing dragon take a little more time usually to unfold because you have to see the pattern from the RL10 reverse. And then it has to take out the PSAR, and now you get the SSC and all that jazz. But this to me is kind of like the connection between plan, prepare, and execute. If at the open, I'm really in the world of execution, I would say that 3 out of the 4 sources of targets are all coming out of the prep from the day before. Hey, it was an open trade, so I already know what the numbers are. I know where my exit is and all that. And if it's a new trade frame from the swing pattern, I already know what the mechanical entry is. It's going to be 5 cents above yesterday's high. And what I'm looking for to trade it intraday is it opened inside yesterday's bar and is starting to move up. And that's where I'm going to buy it intraday. It's a special case that if it opened inside yesterday's bar and did not make a new low compared to yesterday's low, and then it gives me a situation or a pattern that I recognize, and I feel like I could trade with my R10 or my R5, and I have 2 units of reward just to get back to yesterday's high, I can trade inside the yellow zone if that's true. Otherwise, I'm just stalking it and waiting for it to break above, and then I'll take my entry. That's a reliable entry. Or it's one of my usual suspects, EWW, EWZ, etc. And I recognize a standard pattern like a sniper pattern, SSC, Kata 2, collapsing dragon. That's one of the reasons to have that little triumvirate as a compound battle drill is that it always is preceded with a harsh winter. Something says this thing was decisively in play to the downside. And then the R10 reversed to a very precise point. And it moved up enough to hit my PSAR flip. And now the PSAR is going to be my friend on the way up. And I've got a very well-defined entry this way and a very refined collapsing dragon that way. So I love that. I absolutely love that because it's already in play intraday because of the harsh winter. Indisputably in play. And now the 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 last one, or no, let me say more about the situation. Those usual suspects, when at any time during the day, like it moved around a lot in the morning, and then at lunchtime, it chunks into a really tight, sideways, quiet channel. And the Z3 lines are really tightly pinched. And it's tighter than one frog box. Well, heck, I can then, there's my little breakout box. And when it breaks out of the Z3 lines, I can go long or short. So on the usual suspects, that's what I can do during lunch. Because lunchtime is a normal time for that thing to happen. And then there may be a lunch move that's one half the size of the morning move. So that becomes easily frameable as a situation. And then finally, in that opening set of shenanigans, whatever the big gappers were are going to have my attention all day because that predicts a large range day. And if it's a large range day, then inevitably I'm going to see some pattern that I recognize that I could maybe trade. And in a perfect world, one of my usual suspects is also a big gapper. And the best day ever is when I have one of my usual suspects is an open trade and it fired a swing trade pattern and it was a big gapper and I recognize the pattern intraday, then I don't have to do any hard work. So anyway, I needed to get that out of my head to share those ideas with you guys. Now I just noticed that I accidentally was drawing with PowerPoint instead of Zoom, so I get all this crap on the board.
It sounds like for right now, maybe the best thing for me to do is to take some of those usual suspects, maybe just limit it to that, not worry about the day, really scouring the daily report, but just work on those, work them up at night, work them up well, be really prepared, and intraday trade those on 3-minute bars the next day. Pick the ones that look like they're going to be good and just keep an eye
Yeah,
on
I
them.
think there's a strong argument for that. That's also the argument behind the Kata 2 challenge. If you expand the Kata 2 challenge a little bit, you could now be looking for not just Kata 2s intraday, but it would cause you to start with the mechanical frame, because whatever the daily bars were, and it ends up here, you say, well, I don't recognize any mechanical swing trade pattern in there. Well, there's still, in this strategy, there's still a universal entry that just recognizes the high and the low of yesterday. And if this thing opens in the yellow zone, no matter what, that there's probably, however it got to here, there's probably some pattern in there that you can trade. That's a Kata 2 or an SSC or a continuation or a collapsing dragon or something. And there's something really powerful about those two price levels, that you have a negative directional bias when it breaks below yesterday's low and it breaks above yesterday's high. We're justified in having those ideas. So if you had a couple of the usual suspects, then uh, do the mechanical framing on them. Know where the 10-day high and the 10-day low is. You know, that's also the next level of framing. If the first level of framing is the daily, the next one is the 10-day, because the 10-day high and the 10-day low have some power. That when things break above the 10-day high, like if this thing was here and it just kept going and it breaks above the 10-day high, who who's afraid to buy that? You know, all the guys that had the negative bias got smashed, and then everybody that was on the long side of this thing now says, ah, free and clear. I wonder where else it could go. Well, go take a look at where's the 30-day higher? Where's the previous RL10? And that's where you start building those price ladders to the upside, that if it breaks above yesterday's high and it breaks above the 10-day high, where are the next sets of tests or resistances that are going to stop it? Who's going to stop it? Oh, well, when guys are tired of owning a winning position. Oh, okay. Where are they going to do that? They're going to start worrying about selling when it gets to a previous resistance level where it started to fail the last time. That's the beauty of support and resistance. And that's why, to me, the 10-day look back, the 30-day look back, plus any place where the RL10 has peaked, has given you a statistically significant price level where in the past, recently, the bias changed. You don't even have to know why. It just the fact that it did. So I would encourage you to take a look at that. All right, now I've consumed 45 minutes of our time when you're supposed to be briefing me. But yeah, Jonathan, I would say that is a reasonable uh, posture.
Okay.
Um,
Okay. I think that's the best thing to do for right now. I like that
yeah,
idea.
that should give you enough to think
Okay.
about. George, the other thing that I started off with too is that I just want you to remember uh, that the on those 30-minute charts, remember that whole day has 13 30-minute price bars. And if you're using all your ammunition in the first third, this is when the market is most chaotic. There's four 30-minute bars. There's 2 hours in here where the smoke is cleared, but before it gets into the narrow lunch, there's 2 hours when price has a chance to unfold and start moving. And if you're out of bullets after 30 minutes, none of this price action is helping you. So I'd like you to keep marking up the charts on the symbols you're trading so you can see where those signals are happening during the day, and look how orderly they are. How often are they changing direction significantly on the 30-minute? Usually not. There's
Well,
usually something that happens in the 30 minutes, and then you'll see a high or low of the day, and then it'll be like, 3 to 4 hours, and then some other. So there's usually a couple big moves during the day on the 30 minutes where the turning point has been made. And I think there's some stuff in there for you to look at.
Okay.
Does that make sense?
Yep.
Um, yeah, Juan Carlos, I want to talk a little bit about here. So your comment and question was on market types, market classification. You're looking at regression line slopes, MACD, SQN, 200-day moving average. Broad and inclusive. This one matters for swing trades. Shorter time frames, I don't think it matters very much. It might matter a sliver on a day trade, but probably not really. And only in the sense that when price is above the 200, everybody has a positive bias, and the long-term trend followers want to buy on dips. And so they have a tendency to want to reinforce that. But, and when it's below the 200-day moving average, there has been some considerable selling, and everybody's just nervous in the service. And it's legitimate to either have a sideways neutral bias or just don't trade, or be ready for opportunity trading, for short trading in very short steps. Like for me, that's only intraday trading on the short side. Like I do not like holding swing trades overnight. Even in a bear market, I just don't like it, because the 10 biggest daily moves ever were dead cat bounces in a bear market. It was a big gap up and one big follow through day, and all of the shorts that had swing positions got absolutely murdered. Like you might see, hey, it's below the 200-day moving average, and this thing was a 5-day down, and it gave 10 days down, and this thing is just horrible. So I've got a swing trade in. And the next day, there was a big gap up and one huge elephant bar. And then 15 days of successful bear short swing gets murdered in one day. Now, we don't know if that's going to continue up or that's a dead cat bounce. But the top 10 biggest positive days in the market have been after these bearish slides. So I do not, and all featured huge gaps. And where does that come from? It comes from the treasury departments and central bankers of the world calling each other up and say, and they start buying the futures in the pre-market, and the gap up just murders the shorts. So unless you're going to be that frequent of a trader, I say, look, I'll just wait for the market to open. I get 6 hours of painful, miserable selling with collapsing dragons, and I'm not going to hold anything overnight, and I'm going to sleep like a goddamn baby. That's my strategy for shorting on swing trades. I just never do it. You've seen a couple times I've done it in the hybrid swing, but I've got like anywhere from 5 to 20 R of markets money in hand, and I reduce it to a single position of 1/5 of my normal size, just because I just can't. I could never be persuaded away from that position. I don't care. I'm 66 years old. I am not changing that position. Now, what I would also say is, so anyway, the 200-day moving average, I think, is useful when you're looking at the swing trade primarily. It has a little bit of pull for the next day, but it really should be more looked at as a winning idea for swing trade and core trade. The one that's not on here that I think functions the same way for day trading is the 10-day NDX. I think that the 10-day trade location, so if that's my 10-day high and this is my 10-day low, wherever I am in that little condition, I look at that as I'm going to color this green, but I almost think of it as red, if I'm being honest. But the color code that I use is this: green, white, yellow, and red. I always know where my day trade targets are inside that 10-day look back. The first reason is because I'm using the 10-day high as my reasonable price target on the way up. And I'm looking at a breakdown below the 10-day low. It's like a collapsing dragon or a failure trade that it wants to go that way. So I always know where those two prices are. And I always know where, if today that was today's price action, when I'm doing my little daily frames, I always know where the high of the day was and the low of the day was for the reasons I explained at length before. So
Yes.
if it breaks down, so if this is where my yellow zone is based on the 1-day frame, then I'm ready to trade something like, hey, I'm short at a breakdown of the low of the day. I should be able to get short in here. And then if it breaks below the 10-day low, there may be a second position that's available. And if I said my 30-day box was this, then I know where those price levels are too. And that's the essence of that sniper trading. So I actually think for that hybrid swing and the intraday, that where price is within its 10-day NDX is a market classification.
Cool.
And it has the same power for me for day trading as the 200-day moving average does for me as swing trading. Like most of the swing patterns have price relative to the 200 as an important rule about which direction I can go. Now I'm going to say approximately the same thing for the MACD. And I want to say that the MACD and the 10-day really give me a directional bias and not a signal. So it's not a signal. But if that's the zero line in MACD, and I have the bars, the signal line is looking like red, and this rolls over. It can be in it'll then roll into spring and summer and fall. This general region in here really gives me a bias and an urgency to be buying because there was something really powerful about the winter. And as long as it's the winter and this is falling, man, I want to be in that so bad. Especially if the Red River was here. This thing is falling so fast, it's leaving its 30 period moving average and Bollinger Bands far behind. But when it stops failing and starts becoming like the spring, I'm really interested in spring planting, and especially if that comes out of the Red River, so it enters, it crosses the spine and out of the Red River. I really look at this as the optimal planting season. And that if this thing continues on into the summer, and it's easy and obvious what's working here, that these that were planted are going to be your best winning positions, and you might get a second position on those. Now, just because it moved into that area, it is not a signal to enter. It still has to be framed according to whatever specific rules I'm using. Like there has to be some, maybe it's the mechanical entry and the mechanical exit and whatever on a daily or an hourly or whatever. It's still price action on that day of entry still has to go through that threshold to affirm that the positive movement is happening. Because sometimes the price action will just, it was horrible, and then it just slows down a little bit, and it never gives you that mechanical entry, but it might be good enough that this thing goes into the spring and then starts drifting up. But there was never an affirmative price action that told you, hey, they're hitting the asking price and it's going. So I still require a mechanical entry. And I'm going to say the same thing about SQN. I don't really think that that is reliable at all as a market classification. I know Van loved it, but this thing has two components to it